Hey everybody, what's going on? It is James here with Crypto Common Sense, and I wanted to sit down this afternoon and shoot a short video talking about quantity of trades versus quality of trades. So in some of my recent videos, I've talked a lot about different returns and how to get different net R and how to get different net returns. And I showed different examples using different numbers of trades. And I felt like in hindsight, that may encourage people to overtrade a bit. So I want to break this down in detail and show you exactly which route is the best for you. So I decided I should sit down today and shoot a video showing the differences in a fast and loose trade system versus a very tight trade system. Before I jump into the content, do me a huge favor, hit the thumbs up button, make sure to subscribe to the channel, and of course, make sure to click that bell icon to get notifications when I release new updates. First things first, this is just a spreadsheet I made. Anybody can make this, obviously, and what I've done is I've put the exact same numbers in 4 different sections here, with the only difference being win rate. All right, every single section is trading a 2-to-1 reward to risk, and we're talking about after fees, after commissions, after everything. You're making twice as much when you're right as you're losing when you're wrong. All right, so in the first example, this person, let's say they trade Monday through Friday, so 5 days a week, and let's say that they trade 2 trades a day. That's 10 trades a week. Let's say they trade 50 weeks a year, take a couple weeks off for holidays, whatnot. So they're trading 500 times a year. Now, with those 500 trades, that's not a lot of trades. It's pretty easy to find 2 trades a day. But let's just say that because they're maybe a newer trader, they're trading a little faster and a little looser than what they should be, maybe not being quite as on point with their entries. Well, at the end of the day, they're actually going to net over the course of a year 25R. If they're risking 3% per trade, that would be about a 75% return on their account. All right, and just for easy math, I've got $100,000 plugged in here. So 75% return. Let's say that the next trader is only taking 1 trade per day. So they're being much more selective about their trades. On the surface, it seems like they'd have to win a lot more trades or be trading larger trade amounts in order to get the same return. But in fact, it's almost no difference. You can see here with 250 trades and a 36.67% win rate. So literally less than 2% better than the other trader. But that tiny little difference means that even though they're only taking 250 trades, at the end of the year, they also netted 25R, or roughly 75%. Let's take it a step further and say that trader C over here is very, very specific about their trades. They only take the best of the best trades. And as a result, they're only taking on average 2.5 trades a week. That means they're taking roughly 125 trades per year. If they're also going for a 2-to-1 reward to risk and they win 40% of their trades, you guessed it, at the end of the year, they've netted 25R, or 75%. So the difference in taking 500 trades and taking 125 trades, you only got to win an extra 5% of the time. And then let's go down to trader D. Trader D is that person that only takes the setup that looks exactly like the textbook. They never fudge the line. They are 100%. It's either a perfect pattern, it's a perfect setup, or there's no trade. They might be the type of trader who only takes a trade when there's 3 or 4 different converging aspects, which, by the way, is not a bad thing. I'm not knocking it. I'm just saying most people are not this disciplined. But because this person is so disciplined, they're actually winning 46.6% of the time in this hypothetical example, meaning that on those 63 trades, barely 1 trade per week, they are also netting 25R each year, or 75% if they're risking 3% per trade. So which system is the best system? And the answer is, this depends on the individual trader. We're not all built the same way. We have different emotional triggers. We have different things that we enjoy. Some people are very, very disciplined, and for them, this is the perfect way to go about things. Other people, like myself, I like playing fast and loose. I still look for good setups. I'm still looking for good reasons. I'm not out there just willy-nilly guessing. But at the same time, It doesn't have to be perfect. I understand going in that I'm going to lose a lot more trades because my trades are a lot sloppier. But I also know because of the sheer quantity of trades I take, I only need the smallest edge on the market in order to make that work for me. The one thing that I would say, and this is just my experience, this is of course anecdotal evidence, my experience is the better the trade, meaning the more it looks like the quote unquote textbook and the more it looks like the perfect setup, usually the better the return, meaning that you won't actually get 2-to-1 on average. If you're taking super good trades, you might actually get more like 3-to-1, 4-to-1, 5-to-1, etc. So hypothetically, just hypothetically, let's say that this person was getting a 3R instead of a 2R. You can see that that drastically changes this net return number. And maybe because they are going for that larger target, they don't win 46% of the time. Maybe they still only win 35% of the time, just like this person over here. But because they're going for 3R instead of 2R, they're still coming out at roughly 75% return per year on just 63 trades per year. So this video is not telling you to trade less. It's not telling you to trade more. I simply wanted to show you that it's not necessarily more is better. And I felt like in some of my past videos, it seemed like the more you trade, the more you make. And that's not necessarily the case. The better trades you take, the less you have to trade. The sloppier trades you take, the more trades you're going to have to take. The key is whatever trade you're taking, you want to make sure that you have a positive edge in the market. You want to make sure that it's a trade that you're not just guessing, but you actually have some reason to take that trade. Preferably at least 2 reasons. If you want to get really good, 3 reasons. So this is a chart of the Swiss franc versus the Japanese yen. And so if we're taking a look at this chart and we wanted to say, hey, can we find a trade on this? Let's just find a nice, simple, easy trade. What would be an easy trade? So if you see this yellow box here on a weekly chart, it just looks like this weird random box floating out in the middle of nowhere. But if you were looking at a daily chart, this box would look different. And you can see here that what this box actually was this old wick back here, which used to be supply. And of course, when you break above supply, it will often flip to demand. So as an example, and this is one of the sloppier type of trades I'm talking about that I like taking, a lot of traders would pass on this. I'm not one of those traders. I see this come down to this box. Well, that's one reason that I would consider for a trade. Okay, it's retesting demand. And the other reason is because this actually closed as a bullish hammer candle, meaning that, it looks like a hammer. It has a big tail being left behind, which tells me that there's still buyers present. And it has that nice thick body on top, which tells me that, the bulls are still standing strong. Bears had almost no pushback on that candle. Now, this candle does not make me think it's going to go to new all-time highs or anything like that. It doesn't make me think otherwise. It's just not that type of candle. What it does tell me is that it's likely, at least in the short term, over the next couple of days, to probably move up from there. And that means that I can go in there and I can start looking for small scalp type of trades. For example, I might enter on the close of this green candle. I might put my stop down at the bottom of this range. It gives me about a 1.3% stop, and I might pull this up for 2-to-1. And I might take a trade like this. And then what I do on a trade like this, where it is a scalp, is I simply try to get that 2-to-1. I'm not looking to ride a trend. I'm not looking to go for a big 10 or 15 R. And I'm a lot quicker to jump out. If suddenly the trade starts getting shaky, I have no problem jumping out and taking a 1R or a half R or a 3/4 R, whatever the case may be. So maybe the stop is right there. Again, I'd have to zoom in. Maybe the stop was right there and it stopped out. If it stopped out, that's fine. That trade would have made 1R. That's the kind of trade that I'm talking about. It's a very sloppy trade. There's a couple reasons for the trade, but it's not real strong. On the flip side, you go back to a trade like on the US 100 and this daily trade that I talked about in yesterday's video. Well, this trade's a lot stronger. You've got an ascending triangle. That's one reason for a trade. It's broke out. You've got this tail. That's 2 reasons for a trade. Still only 2 reasons, but you know what? These are better reasons. These are not retesting supply from way back where it looks like it's after distribution. This actually looks like it's going to be a new uptrend because, of course, the way ascending triangles work, you measure the triangle, and that's where your target is supposed to be when it breaks out. Or you can use something like a fib tool to do something like this, right? Target up there. So Those are the kind of trades I'm talking about. If I see a trade like that, I'm taking that trade 100 times out of 100 times. I don't need 15 different reasons. Some people, they're not okay with this because the theory is that breakouts fail more often than not. And so they see that and go, no, 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 there's a really good chance that tail's going to get taken out. There is absolutely a really good chance that tail's going to get taken out. Except remember, in trading, I've only got to win 35% of the time. Then I'm profitable. And again, if you're talking about 8R, look at this. Show you what I'm talking about. So you got a trade that looks like this. You got to stop here. And if you're using this measured move target, then you can say that this is probably going to go to this level if it works out 8.6R. So 8.6, we'll just call it 8 for easy math. How often does that trade have to win to make it worth taking? About 11.5% of the time. That's how often I've got to win that trade. That's what I'm saying when I say I will take that trade 100 out of 100 times. Other people won't. This trader over here, this super tight trader may say there's just not enough there for me. I need more confirmation. Those, a simple breakout and a retest doesn't do it. That's fine. Different trade styles for different traders. Hopefully you enjoyed this video. If you'd like to learn more about trading, you'd like to learn more about setups, and you'd like to learn more about proper money management and proper risk management, make sure you check the description. There will be a link down there where you can join my premium training content, as well as get access to my private Discord and my proprietary trade indicators that run inside of the Tradingview platform. Also, please remember, I am just some guy. I'm sitting in a spare bedroom. That means that nothing in this video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. This is James with Crypto Common Sense, reminding you all to please trade safe. I'll talk to you soon.